I had spent some time in the beginning, and I was going to talk a little bit about what returns would look like in 2014 and 15. Just kind of make the point of how different those 2 years were, just kind of set the importance of risk management in general. So I'll just do this fairly quickly is what I'll do. But what I'm going to do is just kind of show you kind of a simple stock budget.
Don't you have a spreadsheet on one?
Absolutely, yeah, absolutely.
How
I can send it to you. To be honest with you, if you don't mind, you can find it on our website. I can give you our website. So I'll give that to you now. It's www.ca.uky.edu. Edu? Yeah, like education, edu. And then slash, add econ. And then find from there you can just go to me. But I can't give you the full URL for it's just too long. You're also welcome, if you just want to email me, I always put my contact info at the back of those PowerPoints. Shoot me an email or give me a call and I'll just send it to you. Sometimes it's easier to give you the actual URL since they're not long. Okay?
I've been trying to pay a little more attention.
Sure, no, I understand.
Now that mentality is with prices high, everybody's making money.
But if you just kind of look at a simple stocker budget, so if we just think about a stocker operator that buys 5 weight calves on April 1st and then sells feeders on October 15th. If we think in those terms, and if we assume that they're pasture-based, they get about 1.5 pounds a day. And if I just think in terms of some basic costs, $35 an acre pasture cost, figure an acre per head, quarter pound of mineral a day at $20 a bag, 2% death loss and 5% interest on the stock or the pasture and the mineral. Just think about some basic costs. I'm going to rewind this to spring 2014. Okay? So the first week of April 2014, 550-pound calves were selling for about $1,100 a piece. And I can't tell you how many people were just blown away by how high those calves were. A lot of my stock operators were just convinced they could not place calves that were that high to stock for that year. At the same time, though, the October futures price, about $1.78. If I just think in an October 78 board, typically it's going to mean something like a price expectation for 8 weights in Kentucky around $1.64. I usually about 14 off for 8 weights, and that varies.
It goes from 12 to 16.
Sure, something like that. It's a guess anyway, right?
Mm-hmm.
But if I use that 1400, Tim, that's $1.64. So the point that I want to make is those calves were 1,100 pounds or $1,100 a piece. But given what the board was, I was expecting to sell 8 weight steers in October at just under $1,400. So I'll talk about gross margin. The gross margin I had to work with was almost $300. Meaning I expected to sell that 8 weight in October for $300 more than I placed that 5 weight. Does that make sense what I'm doing? Mm-hmm. So it looks something like this. And without getting details about cost, this is that spreadsheet, by the way. It looked to me like in spring 2014, I could have made between $90 and $100 stocker these calves. Notice, I've got pasture costs, I've got vet medicine. At the time, I had $44 a head to sell them in there because they were so expensive. Okay? I've got interest, I've got hauling, I've got $10 for other costs, and I've got 2% debt loss. And I was still showing a return, or a quick return about $93. Now, we talked about already what happened during 2014 with the market do.
It kept going up.
It kept going up. Okay? So this $93 I've got up there, way too precise, by the way, right? Okay? So think 85 to 100 bucks, something like that. Was assuming that somebody went and protected that sale price. But the market went up. So those calves that we thought were going to sell for $1.64, I shouldn't say calves, I'm sorry. The feeders we thought were going to sell for $1.64 actually sold for $2.23. Jeez. And that $100 profit that I thought I was going to have ended up being about $600 again. Okay?
counting 2% death loss on everything.
Still gotta do it. Still gotta do it.
Wow.
Okay? Now, why did we make so much money stockering cattle in 2014? Was it because I was a great manager? Nope. The market just gave us a gift. A gift. Now, if back in April, if back in April, I had locked in that sale price via contract or via futures and options, how much money would I have made?
No, you ain't got 93.
Something close to that, right? Now, does that mean I lost money? No. What it means is I didn't make near as much as my neighbors who did nothing.
Left money on the table.
I left it on the table.
Kind of like the grain market a few years ago.
Absolutely.
When it went sky high, I had contracts at about $4.85, and everybody else was getting $7.
I hear
But when I did it, I was still making money.
Exactly.
But boy, it hurt.
And this does hurt.
Every
And,
time I drove in there, you done it, you done it.
and it's not, and it's okay for it to hurt because, this applies to grains too, by the way. I'll use the cattle scenario though. If I made $100 a head and my neighbor made 600, who's in the best position to place the next group of calves? My neighbor is, right? So
Buying you out.
So it's okay to think that way. And I do want to look at things that maybe I leave myself some upside too, and that's a good point. The point I want to make is this was a market we could do no wrong on. I'm going to look at 2015, very different story. Those calves were crazy high, spring 2014. State average for 5 countries was 260.
Yeah.
260 first week in April. Okay?
It's higher than
So I had, sure, would have been probably $10 higher.
270.
Yeah.
We made the kids.
So I would have had 1430 in those calves. At the time though, my expected sale value, given what the October board was in April, was about $1,717. That gross margin really didn't change that much, right? It was $294 in 2014, it was $287 in 2015. That stays fairly constant, folks.
But it just took so much more money on the front side.
But on the front side, and that was the other point I was actually going to make. The gross margin was $7 lower,
Yeah.
but my return was lower because there are some costs that go up with calf values. What are they?
Yardage, it's the sale price.
Sales expense.
Their sales
Yes.
expense
Yes.
is based on how much a calf brings.
So the commission is one for sure.
Commission for it.
Right? So for example, I think I had $43 in there for 14, I got $52 in there for 2015. What else goes up with calf value? There's two other ones that you should probably think about.
The interest rate is usually more money.
There you go. So because I'm borrowing more money or using more money, all right, on more expensive calves, I've got more interest expense. And then how's debt loss impact?
More money,
The value of the ones I lose are worth more too, right? So
and that hurts, Eddie.
So there are some costs that go up with the overall market.
Sorry about you, though.
And that's a good point. I never mean this to hit close to home, sorry.
That's all right. I made a lot of money in 14 and 15.
Sure.
But I don't want to work with.
You hit it perfect, it's not like, to me, you didn't lay me back as fast either, right? So you hit it real well. And then the opposite happened, okay? So the fall board fell by about $26, October 15. Those steers that we thought were going to sell for $202 actually sold for $1.72. And my expected $65 profit really looked like closer to $200. Okay? Now, something else I should probably say is I wanted to keep this consistent. So I stopped this on October 15th. But what did a lot of stock operators do this past year? Because we had a great fall. We really did. They did. Okay? So my point, I could have made this number uglier, right? If I wanted to. But I cut us off mid-October. But it's a good way to look at how bad these markets can spank us sometimes. Okay? So 2014 was the year that we could do no wrong. And 2015 was the year that we almost, if we had not been protecting ourselves, we could have been in a bind. So a lot of people say, well, you know, the two offset, sure. Okay, in fact, we probably made more money in 2014 than we would have lost in 2015. Okay, but I always come back and say, well, you know, what if 2015 was my first year? What if I made so much money in 2014 that I grew in 2015, right?
Let's double this deal.
A lot of folks do that.
That's the,
What if 2015 had come first? Right? Some folks might not have lived to play.
yeah.
So I think these are two really good years to kind of look at the importance of price risk management. There's going to be some years, like 2015, like you mentioned in grants, where you're going to leave some money on the table. You are. It's inevitable. There's also going to be some years when you're going to probably avoid some really tough times. My philosophy has always been, if you're not leaving some money on the table, you're probably taking too much risk. That's always kind of been my philosophy.
I've never heard of stuff like that, but that's exactly right.
You see my point, though?
Yeah.
You know, if you,
Why? I'm glad I lost that $2 in some book.
so think about the years that you might have locked in that corn, and ended up getting $1 more bushel or something like that. And, you know, so you can't look at two things. You can't look at risk management in a single year, right? It's a long-term strategy. The other thing is you can't look at risk management in hindsight. You just can't. All right, and I think I could probably skip this one if you want, but we saw something very similar in the cat market. We saw our cat values go down about at least $300, right? And again, if I'd stopped this one, Tim, and if I'd gone past October, this one would look worse too. But I used a mid-October window. Okay? And those calves in 2015 were worth about $300 less than they were in 2014. So, we'll walk through some future stuff. So, you've probably all at least heard of the futures market. We use it a lot for grains. We use it some for cattle. It's a market where we trade contracts for commodities to be delivered later. So right now, for example, there's a March feeder cattle futures contract, and the best way to think about that is you can think about it as a price expectation for feeder cattle in March in the major cattle producing areas. There's an August feeder cattle futures contract, and you can think about that as a price expectation for feeder cattle in August. Know the basics that you're looking at when you see those contracts. First of all, understand we're talking about 50,000 pounds of feeder cattle. So the 50,000 pounds is significant. Why?
That's the semi-low.
Exactly. That's the yield we typically trade in. There's 50,000 pounds. For right now, when you think about a feeder cattle futures price, I want you to think about a 750. The range is 650 to 850, so it's kind of centered on 750. I wanted to make sure I did not forget this, so it's going to be in here again because I was scared I'd forget it. But the CME is making a change that takes effect in November.
Really?
They are. So there's
Just 2016 November?
it starts in November, okay? So they're going to shift that range up from 650 to 850 to 7 to 9. So that midpoint's going to shift from 750 to 800. Does that make sense? In fact, let me just go ahead and skip, and I want to show you it because it's important that you. This is maybe the most important thing that I say. So this is the futures market from yesterday. Okay, I don't want to know what it did today. Don't tell me. All right, it's too late. I can't.
It's a,
Yes. All right.
I got it right here.
Since you said it, how much is it?
Which one?
Feeder. Give me March feeder.
March feeder's up 50 cents.
Okay. So notice October is at 153.60. November is at 149.50. It's impossible to read on there.
That's what I was thinking.
Yeah, sorry about that. No way to do that. It's hard to do. Understand that part of this break is because of that weight difference, right?
Okay.
These cattle are 50 pounds heavier than these cattle. So that's probably pretty close to a flat market if you take out that weight difference, right? So price slides move with the overall market, But with the prices we're at now, we're probably gonna see about an $8 difference, I'm gonna guess, between what, $7.50 and $8.50 sell for, okay, about $8 price slide for 100 pounds. So that 50 pounds is probably worth about $4, and if you adjust it for that, they're about the same. Does that make sense, guys? Yeah, we good? Okay. Sensible. Questions? So just be aware, when you look at November, you kind of got to adjust it. So the basis charts I'm going to show you that I've been keeping for years, I'm going to have to adjust them for this here real soon.
You got that written in there anywhere that this thing rate change?
Yeah, it's on, and I don't know how to tell you which slide it was. It'll be on the contract spec slide. So go backwards. Yeah, go backwards and it'll be on, I can show you. So it's actually on,
I want to circle that for fun.
yeah, no, absolutely. Let's take our time to do it. So it's right here on this one. It starts out just feeder cattle contracts.
Oh, okay.
Okay. So the thing to understand is that as you compare the prices you sell cattle for to the futures, yours are going to be closer to the futures price now because of just the futures price of it. Everybody okay?
Why'd you say the real purpose of that was? What did you think?
The only thing they said, now understand that the Chicago Mercantile Exchange does this.
It's just USDA or the
Well,
board?
it's the mercantile, the CME group, and they said it better, they think it better reflects the market, meaning there's been a whole lot more of those.
Just everybody's running up there.
Exactly. Now, some of that may have been a function of higher feed prices the last few years too, but they're shifting the way. So what I'll do with my basis charts and tables, just so you all know, I'm gonna keep them like I have been, then I'm just gonna tack on another adjustment that's gonna be artificial. And it's gonna be my best guess at what the price slide is on 50 pounds given the market. That's all I can do. Because everything I've got is based on the 750s. And over time, I'll be able to build it, other database no change. So my basis numbers will shift about $4 a hundred. We do hogs. We trade feeder cattle contracts in 8 months out of the year. This is we trade 3 spring contracts, March, April, May. Then we trade 4 what I kind of loosely call fall contracts, August or November. Skip December, skip February, skip June and July. And they just skip certain ones to have more volume and to have more volume in the other. So these are most closely when they actually cash in the sell. So I'll skip a few things here too. So what we're really going to talk about here in the next hour or so is how we can potentially use the futures market for hedging purposes. And then certainly I hope that you all will learn a little bit about how to use the kind of information that it provides. So rate of report is fairly simple. And you've probably already seen this, but I'm going to do it real quick anyway. So this is the board from the internet, and I pulled this down last night. Okay, so this is every trade through yesterday. The most important column is the last column. If I just simply said, what's the current price of the March futures, the answer would be 157.65, and that's obviously dollars per hundredweight. That next column, the change, is just the change from yesterday, from the day before. Okay, so if you look at those changes, for example, March was down 12.5 cents per hundredweight. May was up 15 cents per hundredweight. That was a pretty flat day on the board. Even your 50-cent jump today, given the way these things have been moving, 50 cents isn't that much, right?
No.
That's how volatile things have been.
Not when they can expand limits, it's a pretty calm day.
There was a time when I would have thought 50 cents was a big jump, but not anymore. If it's less than $1, I don't really even think about it anymore. The others are straightforward. Prior settled would be yesterday's close, and I mean the day before. Opens the first trade of the day, highs obviously the highest trade of the day, lows the lowest trade of the day. And I put those definitions in there in a slide I can show you, so you've got it. In terms of actual positions, so you guys probably don't need this level of detail, so I'm going too slow, stop me, okay? But one of the things that the underwriters I work with have trouble with is that they have trouble with the notion of, well, how can I sell a futures contract before I own one? How can I short the board first? And it's tough to get in your mentality, but there's examples of us doing this, all right? So, for example, if Tim had a bunch of calves right now, and if he wanted to, he could sell them to me today. And I could just say, okay, I'll buy them from you today, and I want you to deliver them in April. And it's kind of the same idea, right? He could sell today, and he just has to deliver the cattle later. It's the same idea. Conceptually, the thing to remember is that if I sell futures first, then all I have to do to get out is I've got to buy futures back. Okay? So, if I sell first, then I buy back. Okay? If I sell first, what does the market have to do for me to make money on futures? Just think futures. Sure. If I sell first, and the market drops, I buy back at a lower price, and I make that money on futures, right? If I'm a cow-calf operator who's got calves to sell this spring, if I'm a winter backgrounder who bought some calves in November that I'm planning to sell in March, what am I worried is going to happen to the cattle market between now and sale? I'm worried prices are going to go down. Okay? So if I short a futures contract and the market goes down, I can make money on futures, which is going to offset the fact that what?
I'm gonna lose money on the cattle.
Yeah. But the cattle are going to die, the cash.
Right.
So if you can get that in your head, you're really halfway on. We're just thinking about what should I do in the futures market? What can I do in the futures market to compensate me if in fact this market doesn't go down? Who needs you to show them how margin accounts work? Would that be useful, or are you okay on those? Have you traded yet? Okay, so margin, no. So the way this works, if you trade futures contracts, your broker is going to ask you for a certain amount of money that works like a deposit. They're going to say, all right, if you've got this much money tied up in futures, I want to know that you can cover a loss you might incur. So let's say, for example, last year, I had sold November futures at $2.30 or $2.30 a hundredweight. The actual value of that contract is $115,000 because it's 50,000 pounds, right? Fortunately, they're not going to ask you to send them $115,000. But they're going to ask you for a portion of that money. This varies from broker to broker. I've seen as little as $1,500, I've seen as high as about $7,000. It just depends, okay? If you have cattle or if you have grain, they typically don't ask you for as much money because they understand you've got the physical commodity to back it up. You're not speculating. So they view it as less risky. So let's just say, to keep it simple, they ask you for $3,000. And then we'll also say that we just assume you have to keep $3,000 in there. So let's say that today I sell futures at $2.30. I make a $3,000 deposit in my margin account. The very next day, the board falls to $2.28. Have I made or lost money on futures? I've made money, exactly. How much have I made?
$2.
I made $2 a hundred. And the contract's 50,000 pounds, right? So it's 500 hundredweight. So $2 on $500,000, right? So that $1,000 goes into my margin account. Now I've got $4,000 in there. So I've made money on futures. But, again, we're not speculating. We've got actual cattle. So what's the bad news? I made money on futures, but also cash. I most likely saw the value of my cattle in it, right? Any questions at all? If instead the board rose $2, you know what this is going. Okay, now I've made a lost money on futures.
Awesome.
Now I've lost that $1,000. They're going to take that $1,000 from my margin account, Now I'm at 2,000, if I have to keep $3,000 in there, they're gonna want what? They're gonna want another 1,000, that's what a margin call is. Okay, now, back in the day, it was physical phone call, right? That's changed. But they're gonna ask for that $1,000. Okay? But again, if I get this margin
They
call,
can get the phone call where they want 20,000 or something. I've had that before.
and that happened in cattle, by the way, in 2014. It sure did. It's more common than grain.
That's when you think, man, I'm really stupid.
Well, mine don't know why, that's not a question.
He's pretty tough at it.
Yeah, he's
I talked to him, too.
We've been, talking about a lot. That's, so none of this I haven't heard before, but it's good to hear it again. Sure, good.
So no one is usually happy about a margin call, but what is the good news in the back?
Okay.
You know, your cattle should be working, right? And you know, if you're operating on borrowing money, and a lot of us are, you know, what's important is you gotta make sure your lender understands what you're doing, right? If they're covering your margin calls, make sure they understand what you're doing, and they understand that this is covering your downside. You might need short-term money, but it should balance itself out. Any other questions? All right, that sounds right. I agree. Any other questions? Okay. I'll talk real quickly about feeder cattle basis, but the first thing to understand is that feeder cattle futures are cash settled to Western markets. So you need to understand that when you see a feeder cattle futures price, you want to think about 7-weight feeders, all right? In the Dakotas, Kansas, Oklahoma, Texas, think about that southern part of the country. Okay? And that's where the bulk of feed yards are. So why are our feeder cattle typically cheaper than the same kind of cattle out west? Period. Transportation. That's really all it is. Okay? So basis is just that difference between what our cattle sell for versus the futures market. So if the futures market is based on 750s, it is right now, and we sell 750s in Kentucky, they should bring less than the actual board, because the board is based on the west and we have transport. So that's really what you got to remember.
12 to 16.
Well,
No, it's not, and I have never understood why that is. I mean,
yeah, how come
if I contract a low cage, it's 12 to 16. Sometimes if you're lucky enough, and the market might be flattened out or still creeping a little bit, and you go to the CPA sale, it'll be darn close to whatever the board is on premium value added cages.
So I track basis over time. I do pretty long. Now, understand that all I can really track is state average, right? So everybody's basis is different. So when Tim talks about CPAs, understand, those are probably not 750s on average, right?
No.
And they're also higher quality calves. So that impacts their price. So they will have a stronger basis, that makes sense, they'll have a stronger basis. If I look at the state average price for 750s, and the reason I do this is because this gives us an idea, this takes the weight element out, right? This is the same weight as the futures. Here's what it has looked like over time.
So in August, you're saying it was only a $2 basis?
Yeah, over the last 3 and 5 years, the red line there is a 3-year average, black line is 5 years, and I typically do it that way, okay? Notice though, they're pretty consistent, okay? Our strongest basis time is usually in the summer, and our weakest basis time is usually here in the fall of the year, okay? So we'll be pretty close to the board for our 750s in the summer, and we'll be something like about 12 under on 7 weights in the fall.
So in August.
Okay?
So why is August basis smaller?
So the thing you have to think about, you all tell me what you think it is. So
Lack of numbers?
some of it's numbers, no doubt. Understand, don't think about the market. This is the differential between out west and here.
Well, that's what I'm saying, numbers. So in October, you got more spring wing calves flood the market, and they can get that basis. And in August, I assume the numbers are smaller, and they're looking for more cattle right before that weaning period.
And again, it's the difference between our markets and the board. So
Right.
we sell a larger proportion of our cattle in the fall. Make sense?
Okay, yeah.
So our markets get hit harder than the western markets in the fall, I think.
Say it one more time.
So, we sell the majority of our calves, or not just calves, but calves, pigs, and everything. We sell the majority in the fall of the year. Okay? Probably more so than the western markets. So our markets get hit harder than the western markets in the fall, which makes that differential kind of wide.
August is always, when I'm talking about the CPA sale in August in Owensboro, it's always been the top of the market, almost, except for one time, every year, versus February, April, August, and December on the sale dates. And August is always higher, but I guess it's because that basis is smaller.
Feeder cattle basis is always harder to track than grain. Grain is typically a little bit easier because you can think about what makes sense with harvest time and storage and stuff. Feeders are going to bounce
So
around.
a lot of guys that cave the fall, will hold those wean calves, wean them in June, or they have to be weaned 45 days before the sale, leave them on the cow, or long wean them in 60 days, and then sell them in August and get that premium.
So when I'm making price projections, there's lots of ways I do it. But one of the things that I do is I look at the future price, and I look at what our historical basis tends to be,
Yeah.
and I adjust that way. I'll also say this, 2014 to 15 were odd years. They just were, let's be honest. But when markets are moving that quickly, basis tends to be kind of strange sometimes, right? So, I don't think that historically we should expect our basis to weaken $10 from August to October, but it has over the last 5 years on average. Okay? Also know that these are averages, right? Which means some of those years it was going to be better and some years it was going to be worse. But I always do try and track this. So does this make sense what I'm showing you here? Any questions on it? It's just a differential between the board and the Kentucky average price for 750. I was not able to update my 850 one for you, so it's about 2 years old. I did want to show you though. Let's see where we're at. I want to show you the calf thing too. We can track calf basis the same way.
Really?
Now it's very fluid because the same things that affect the markets for heavy feeders don't always affect calves, right? So there's a graphs and main effect on calves that doesn't impact centiloids at all. But this is what our calf basis looks like. And I probably should have almost started here, but notice how strong our basis tends to be in the spring of the year versus how, and I shouldn't even say weak, but how much weaker it tends to be in the fall of the year. So why is our calf basis so strong in the spring? You weren't talking about it.
Right?
Yeah, this is grass land, right? We're bidding up the price of calves in the spring because of grass, and we're not bidding up the price of centiloids because of grass, right?
Right.
Does that make sense? The other thing to understand is the futures market is based on what weight?
750.
Right now, I think 750, and these Kentucky calves that I'm showing you are what? 550. So another piece of that's just a weight difference, right? 5 of so.
You can haul more numbers, you can haul more 550.
That's it.
How many is it probably?
800 pounds is 48,000, which is what they want, so whatever it is to get to 48,000.
I tell people think 70 head of 7 points, so 70 head of 7 points.
Number of 60.
Yes.
68.
56 to 60 is what they want on
Any questions? All right. All right, so that's the idea.
That's 87 to 550.
Hold on.
So, they can, 87 to 60.
So I always make this offer, and I'm glad to do it. I think I have this for you, and I can't remember one time.
We've talked several times,
Okay,
but I've always backed out.
that's fine. But basis is very unique, so I can track state average, you know, but I don't know what your basis is.
Right.
But if you have record of what your cattle have sold for, you know, in the past, if you know when you sold them, what they weighed, and what they were, I've got historical future prices for the last 50 years or so. So it's no trouble for me to run you some base estimates for yourself. And I'm glad to do that, just holler, you know, out here. It's looking all at all. So I've got historical futures prices. If you've got your individual prices you sold cattle, I can do that for you. So something we should do, by the way, we should get your all CBH data over the last 10 years. And we should run base estimates on that separately. It'd be good to do.
I bet it's like a trampoline.
It's gonna bounce around some,
Yeah.
but, you know, grain basis bounces around
Yes,
too.
sir.
I mean, it's a moving target. The way you wanna think about this is, basis is probably gonna be less variable to price. So you think about how much feeder cattle prices went up during 14, how hard it came down in 2015. Basis probably didn't change that much, right? It should. And the way I say with the farmers, you just keep in mind, when you hedge, you're really replacing price risk with basis risk.
You'd think the basis would be getting less with diesel fuel going down.
It should. You're thinking exactly
But it
right.
hasn't.
You're thinking exactly right.
It's just like all these companies when they got real high with this.
Surcharge on. Still on there.
Yeah, it seems like.
I know something like that, though, yeah.
Still on there. And
Tax me,
I remind my sales rep on feed bills.
You're exactly right. Diesel fuel should be a major driver of basis. Yep. Absolutely. No doubt about it. For cattle. You're thinking exactly right. I actually did some research, not maybe about on names, but we did some research and we tried to model basis over time. And we did it with CPH data and with another data set. And diesel was significant in explaining basis in one model, not the other one. So you see, it's even inconsistent, it's not all consistent anyway, but it should have been, right? It definitely should have been for cattle. It's perfectly logical thought. Most trucking companies, rule of thumb for cattle hauls, you know, about diesel fuel price per litre mile. Kind of rule of thumb, so. And I mean, road diesel now is what, $2.50.
Here it's still closer to $3,
Okay,
but it's under $3. I have got it for $2.40.
or $2.50 or something like that.
Road diesel. Yeah. Anyway,
Well, wholesale it's under $2 now.
I figured it was for farm diesel, but
Yeah.
most trucking companies are.
On-road and off-road is under $2.
Any questions? Okay. So let's walk through some examples here. So the idea of using futures to protect prices, we're just going to look at a way that we can use the futures to offset a potential loss on cattle. So simple example. I've got a group of calves that I'm currently backgrounding and planting some in March, or we're in March. If it were early, if it were later in the spring, I'd probably use a stock operator, or kind of in the middle of what a stock operator would do in winter backgrounders. So we're just kind of use March. So I'm going to look at locking the price. Now, March board yesterday was around 158 something. We're going to round and keep it simple. We'll pretend March is about 160. And if you remember that basis chart, we're going to assume that probably I could sell 8 weights in March for something like $12. Okay? So if March board's at 160, I'm going to assume that translates to something close to 148 for 8 weights in Kentucky. So I'm trying to protect that 148 sale price. And I won't get into this, but the reason I would want to do this is because maybe I think that if I could get calves placed, or if I had calves placed for $1.70, and if I could sell my 8 weight steers for $1.48, I could lock in some sort of return. And when I did this, I can't remember when I put this actual budget together, I do so many, but the return was roughly $70 a day. So I'm protecting that $1.48, but understand what I'm really trying to protect is this number right here, right?
Mm-hmm.
I'm trying to lock in this $68 return and hope that it doesn't go negative or go down. So that's the active count. So I own feeders today. Today I go ahead and I sell a March feeder cattle futures contract. Come March, I sell my feeder cattle however I want. Stockyards, order by, whatever I want to do, I sell them, and then I just simply offset it right back to that March feeder cattle contract. Any questions on what we're doing before we go through the example? So if I do that, the board's at 160, my basis is, I think, about 1,200, and that's a guess, of course. So we'll use what makes sense for you if you're gonna do it. I think I walked in a price around 148, because I think I walked in that $67 return. So the first one's simple. Let's say I do this, we fast forward to March, and the market's not moved with this. So I see it, that's the one that we know is not gonna happen, right?
Yeah.
So
That's okay.
the board's still at 160. So I sold the board at 160, I've got to offset, I've got to buy back the board. 160. Okay, so I've got no gain or loss on futures. If I was close to my basis, I sell my calves for $1.48, no gain or loss on futures, I net the 148 price. And if I net that 148 price, and if my other costs were close, I should make how much net on these gains? That $68 exactly. Okay? That this is the easy one. So I've locked in that $68. I'm going to ignore commission, but if you're working through a broker, you're going to pay probably between $60 and $90 to do this in commission. That's what most brokers are charging, a little under 100 in Lexington. If you're using some other ones, maybe a little bit less, maybe, but something like that. So it's not a lot of money in the greater scheme of things, but it would work out to be something like probably close to 15 cents or so per 100 weight. So I'm saying you're netting 148, when in reality you're probably netting maybe 147.85. We'll keep it simple and round. You can also trade futures online, just like you can stocks. You can use E-Trade or lots of those kind of futures brokerage accounts, and they're those are dirt cheap commissions. If you're comfortable doing that, you don't need the broker to buy. So you got another option there. But most people I tell, use a broker in the beginning. What we've done with folks I work with, have used online brokers. Make sense? Okay. The other possibility, the prices fall. March forward falls from 160 to 150, so it falls by $10 a hundredweight. Those calves we thought were going to sell for 148 sell for 138, so they sell for $10 a hundredweight less. What do we assume our expected sale weight was?
850.
850, okay? So $10 a hundred is a dime a pound. On 850s, how much is that per head?
$85.
$85.
What was the question?
If the market had fallen by $10 a hundredweight,
And losing $85 was the market went down $10.
so that 10-cent drop is worth $85, right? The only point I'm making is that's enough. That's enough to turn that $68 gain into a loss, right? So even a change like that, it's not that big a change anymore over several months. It's enough to turn that bottom line red. But if this happens, my calves bring $85. My feeders bring $85 less a head, but I make $85 in feed. So I still walk away with the $68 profit. Makes sense? And then the reverse is obviously also true. The board goes from 160 to 170 in this case. I might have misspoke, didn't I? I think I said that backwards. You understood that you would have made money on futures, right? Yeah. I said it right.
Yeah.
All right, sorry. Okay. So in this case, the board rallies. We add $10 to feeder cattle futures. March futures were trading at 160, come March they're at 170. I sell my cattle on a stronger market. They sell for 10 cents more per pound. They bring $85 more per head, but I lose $85 on futures, right? But I still net the 148, which means I still walk away with that $68 profit. And I could keep doing these till the cows come home, and we still walk away with 148. And in a while, it would always work out to be 148. I made one assumption here, we kind of talked about already, that we're kind of sure of that.
The basic.
Yeah.
The basic.
Yeah. Well, we assumed basically exactly as we thought. So how would things have changed? What if I expected basis to be 1,200 and it ended up being 1,400? How does that affect my net price?
You lose $2.
Exactly. So my 148 becomes a 146, right? So I always tell people, if you're not sure, be conservative, right? Give yourself some room. Questions on this one? We okay? Let's go ahead and walk through options, because I think that's probably where more people would like to see us go. The idea of trade makes sense to you, right? That was easy. Okay. Let's do options. So I'm going to keep it really simple. We're going to talk about a put option. You've heard the term forward. A put option is the right to sell. So we've been talking that March futures contract is trading at 160. I could buy, if I wanted to, the right to sell March futures at 156. If March futures are at 160, and I've got the right to sell at 156, what would have to happen in the market before I would want to exercise that right to sell?
Market comes down.
The market's got to fall below 156 before I can make money on my option. Does that make sense? Okay? And I'm going to pay some premium for that. I've probably taught this stuff maybe as many as 50 times, maybe more than that. And I just kind of just kind of jump in. So here we go. All right. So I'm showing you 3 different strike prices up there, and I totally made these up. Okay. If March futures were at 160, maybe I could buy a 160 put, a 154 put, and a 148 put. Okay. So the 160 is the right to sell at 160, the 154 is right to sell at 154, and the 148 is right to sell at 148. Which one's going to cost me the most?
160.
Why? You're right. Why? I can't afford it. But why is it going to cost the most?
Unless change that the market's gonna change, you're
okay. You're fine.
You're buying the premium price, so you're protecting the optimal.
Very good. Right.
optimal, that's a good word.
So here's another way to say it.
You're taking no loss at $1.60, it's gonna cost you a ton more money.
If I'm cheaper and I buy that 148, how far does the market have to drop before I make money on my put?
12
$12.
12 or 13.
Probably 13.
148.
Exactly. Okay? So another way to say that is, I've got to self-insure. I've got to eat that first $12. Does that make sense what I just said? Okay? If I buy that 160, it's like having a zero deductible insurance policy, right? It's the same idea.
Yeah,
Right.
exactly, full coverage.
And, no surprise, the lower your deductible is, the more you're going to pay in premium. Same idea. Okay? So if I buy that 160, as soon as the market starts to drop, I start to benefit. If I buy one of the cheaper ones, I've got to self-insure some of that. I have a deductible. Okay? Any questions at all? So, you would price these. Maybe that 160 for March would cost you $5 a hundredweight, which would be $45 a head on these, Maybe that 154 cost us $3.50 or $4 a hundredweight. Maybe that 148 cost us $2.50 or something. Whatever it is, you're going to price them. And then you pull that budget in, and you can plug that premium in there, right? So that's a cost.
Or you go.
And then say, if that happens, how does it affect my net price? And you can kind of look at, all right, well, maybe I buy that 154 and I spend 25 or 30 bucks a head. And maybe I at least guarantee myself that I'll break even. So my worst case scenario is I'll break even, but I hope for that, something like that. Okay? And it's up to you all how you choose to do that. Does this concept make sense? All right. Let's skip through this. We talked through it already. So let's walk through it real quick. So same scenario, all right? I got a group of steers that I've been backgrounding. I'm going to sell them in March. Same exact scenario. I want to look at setting the price floor. March futures are at 160. So before I showed you this chart, now or today, I've got calves that I plan on selling, calves again, sorry for doing that. I've got feeders, right? I have calves that I bought, I plan to sell as feeders in March. And instead of selling March futures, I'm gonna buy a March future put. I'm gonna buy the right to sell March futures. Come March, I'm gonna sell those calves however I want to, and then if I want, if I can make money doing so, I'm gonna sell back or exercise my March futures. I wanna make sure you understand this slide. If you don't stop, we'll take our time here. So, if March futures are at 160, let's say that I decide, you know what, I want a pretty high coverage level for the next 60 days, because I don't want to bear a lot of risk. So I say, all right, I'm going to buy a March 156 strike price. That's going to cost me $3. Okay? So $3 a hundredweight on 850s is $25.50 per head. Okay? Again, how much market drive do I have to self-insure if I buy that 156 bush?
How much money?
How much market drive do I have to self-insure if I buy the 156 bush?
$4.
Right, I have to eat the first 4, and then after that, the put else, right. So my basis is still 1,200. I think I've set a price floor of 141. I want you to make sure you understand where the 141 comes from. Okay? So, if the market falls from 156, I start to get help. Okay? So 156 is kind of my worst case scenario for futures. If the market goes to 156, and my base is 1,200, I probably sell my cattle for what?
144.
144.
That's
We
right.
good?
Yeah,
Yeah, 144.
and the $3 is what you've got in the cage book.
And I'm out $3 on premium. Make sense? Okay, so the price floor I set is 141.
All right, I think I know,
Okay.
for Jeff's sake. What's the definition of price floor? You have to set a price floor.
So,
I mean, what's the price floor is, how you gonna get that?
how did I get there?
No, I know how you got there.
Okay.
Who's gonna floor that price?
Okay, I understand. So, let's just do a scenario.
Okay.
Let's say that,
I don't understand the question. What do you mean?
What's the price floor mean? 141 is what you got to have out of the cattle, right?
well, that's,
No. That's what you're gonna end up with because of the transaction that's made.
Well, I'm getting this term mixed up with under the table if they floored the price.
So let me ask a question on your behalf.
Yep.
so I understand, we're gonna get it just simply in 2 ways, okay?
Okay.
First thing is, we're gonna sell our cattle, right? That's a piece of it. And if the market drops really far, and our cattle sell for a lot less, how are we gonna make money on futures
The put.
with the put?
After, once it goes down below your put of 156, then you start getting money from that.
I understand that. I'm just getting that term mixed up with the term they use at the stockyard where we floored these at.
I don't really even know, when they use that term, Kentuckiana, what do they mean? Do
Well, they
put
mean
reserve on
that,
it?
they're saying, Jeff, if you'll bring your 60, we'll guarantee you
Okay.
141.
Reserve.
They may only bring 139, we're gonna guarantee you 141.
So
They call it floor,
Okay.
price floor.
It's like a reserve.
But it's a different term,
So I
though,
never
right?
hear that because they don't like my cattle. You're a privileged person.
I don't ever get it either. It's like when you used to go sell at the tobacco warehouse and they'd give you a belt buckle or a pint of whiskey. So if you was,
Yeah, if you were one of the good ones.
I would have rather had that than what we sold the calves for in December.
The belt buckle would have been better.
Well, it would have been much better, would have been worth more.
well, you know, I mean, that, obviously it's two different. I understand yours, but I wanted to make sure it wasn't tied.
They're similar, not like that.
They're just guaranteeing a bottle, like.
Exactly. So, your question will kind of be answered here in the scenarios too, so. First one's a simple one, all right? But the market stays flat. So March is still at 160. I've got the right to sell at 156. Do I want to exercise the right to sell at 156?
No, the market's still at 160.
Sure, because if I sell at 156, I have to buy back at what? If I sell at 156, I got to buy back at 160, so I'm going to lose, okay? So what that really means is my put probably isn't worth it.
It's going to expire.
No one's going to pay me anything for it, okay?
But that's the thing about a put. All it is insurance.
It is, it's much like insurance.
You really want it to expire worthless.
No doubt. Absolutely.
Homeowners.
Same exact thing. Someone was here, back when the beginning farmer program, it was about a year ago, almost like that. And it was someone who did some user trading, and I think he made the statement several times, I don't use puts because, I think the number, I think he said 85% expire.
Or expire, that's right.
And he's probably right. But
That's what you want.
But so I've been a homeowner now, I'm 37 years old, I've been a homeowner 17 years. Okay? I've had homeowners insurance 17 years.
Never had it
Well,
come.
I actually have had a claim. I had one claim.
There you
all right?
go.
But it was a small claim.
There you go.
But my point is, I mean, literally,
Yeah, I mean, that's what you do.
my homeowner's expired worth was 16 years out of 17. But it still doesn't mean I shouldn't have had it, right?
It's protection, just like this protection.
Exactly.
You know, your homeowner is what you use least. All your insurance is covered around, that's one you use least, right?
That's true, yeah. And, you know, most of our deductibles are $90,000. So, you know, you're not, it's gonna take a pretty big event to make that.
Do that, yeah. But we sat here and buy it like year after year.
But the reason we buy it is because I personally, I cannot self-insure the value of my home.
Right.
I can't take that kind of hit. You know, and I think even if I, you know, was,
Good, I wouldn't want that.
yeah, I think I don't want to self-insure that risk.
But that's why we do this.
Yeah.
We're wanting at least to get 145 or 148 rather than
Yeah,
have a
exactly.
crash and get 120 and be a disaster.
Tim seen me do this, but, you know, I buy homeowners insurance. I don't buy insurance on my phone. Because I can self-insure this phone.
Right.
I can. I'm not gonna be happy about buying a phone. You know what? So I just made a decision, I can self-insure this whereas I can't self-insure at home. And there's times when we probably shouldn't be self-insuring our cattle. You know, maybe you can, maybe you can, but you don't have to. Anyway. So this one's simple. To your point, if the board goes up, all right, let's say prices look like they did in 2014, okay? So the future market goes from 160 to 180. If that's the case, I'd probably sell my cattle for something like 168. Here's the beauty of a put versus selling the board. If the market went up 20 bucks and I had sold the board and used a hedge, I would have lost that 20 bucks. Okay? With the put, how much am I out?
$3.
I'm out $3 in this case. So I sell my calves for 168. Obviously, I'm going to exercise my put, all right? But I walk away with 165. So I didn't truly lock in a lower price for my calves. I didn't lock it in. I set a floor, I paid some premium, but I got the benefit from the rise in market. So me and two of my buddies run about a load of cattle a year. More for fun. Starter cattle. Okay? We sold, I don't know if fun's the right word, more expensive. I'm a little better at what I do if I have a cattle.
There you go.
So,
There you go.
so anyway, we sold the board in 2014. All right? Left a lot of money on the table. We talked up at least 15 grand.
Yeah.
Now, understand, we're not competing ourselves by that. We knew that was a possibility.
Because you had your profit already penciled in.
A student I had in class that same year, graduated, her and her husband ran their first group of cattle that same year. She bought a put and spent almost exactly $3 on it. She made twice what we did. And then that's fine. I mean, that's fine. Huh?
She called you
Well,
today.
sure, she did.
In 14, she made money buying a put?
She made money on the cattle.
Okay, gotcha.
No, she lost her $3.
Right.
But where we locked in,
Where you look?
she had upside, we didn't. Okay? Now, by the way,
There you go, upside and downside.
Do it.
That's new terminology. You haven't covered it yet.
Well, so So she was able to benefit when the price went up, we weren't.
That's why I always use puts.
I mean, they give you
I don't want to be exposed in the future market. I lost a bunch of money on that.
Yeah, I understand. I mean, we kind of did in 2014.
I'm just not gonna do it anymore, so I use puts on train, and I started, like I said, back in December. Okay. First time I ever done it.
Well, I started buying puts at we went to that meeting last year. But I was doing both, but that was stupid.
I remember us talking about this. It's just been so long. I
I
don't
was
think.
thinking, what
You're
are
doing
I
both, both.
Well, I'd buy kegs, and before I get them sold, that next week I'd get a put. But then I'd be offered a contract sale price, which locked in my profit.
That's right. You were sitting on the foot at the same time. Yeah.
Yeah.
Yeah, if you got a cash contract.
Right.
That
You don't-
covers your downside.
You don't need a put.
Yeah, that covers your downside. So anyway. All right, now, here's your question, Tim. So, if the market goes down, all right, let's say that board falls at $20 now. It falls from 160 to 140. If I'm close on my basis, the board's at 140, I sell my cow for $12 less, they sell for 128. Okay? Now, I've got the right to sell futures at 156. Futures prices at 140. So is that option worth something? It is.
Just $7.
Well,
Or 10.
so I've got the right to sell at 156. The board is at 140.
Oh,
So it's worth at least $16. It's worth $16 a hundred if I exercise it right now. Worth at least that, makes sense?
yeah.
Okay. It's worth 16 bucks. So I sell my cattle for 128. I make $16 on my futures position. That puts me at 144. And I'm still out what?
$3.
$3.
Awesome.
Okay?
What's 144?
I sell the cattle for 128. I make 16 on my put. I spent $3 in premium. I'm right there at my floor.
Netted is 140.
So that's how you get there. Now again, this is not what I want to happen. The best thing that could happen would be is if I had spent that $3 and looked back and realized I wasted it. That's the best case scenario. But, you understand, what would my net price have been for these calves that I not had put?
125.
120, well,
125, I think.
Oh, yeah, 128,
8, right?
because you wouldn't have had to.
And if I had plugged the 128 into that budget,
Uh,
I would have lost money. Right? I would have lost $1 there. So that's the idea. I'm going to show you, trying to watch our time as best I can. So I'm going to skip on and show you kind of some things there I think are important to wrap up. So any questions before I kind of get to some text, to some conceptual stuff? All right?
You do a good job explaining.
Thank you, I appreciate that.
You're super good.
It's a harder thing to do. This is the hardest kind of training I do, folks.
You're good.
The hardest I do. It's the hardest I do. I appreciate you saying that.
You better get so lost and afraid to ask questions.
And then, I understand.
I've never been scared to ask questions.
I will say, David and I went through Master Cattleman, maybe 2008. This is before I was ever extension agent. And I was telling somebody yesterday, it was like the one talk, I mean, that's like a 10-12 program, and the only thing I remember was Kenny's talk on like futures and the marketing. It's the only thing that really like took root and stuck with me.
So, don't feel bad, Don. This is a hard thing, and you never catch it all the first time. You just don't, and it takes time. I've also got publications on this that sometimes help if you read through those, that I can get you. So,
I guess I've got several questions, but I don't know when to ask them. I got baby calves being born right now, and I'm gonna sell them as 8 weights or 7 to 8 weights. Should I look at and maybe get a put now,
you could sure look at it.
or is it too early?
It's awfully early, and the thing about a put that far out, if they're baby calves now, they're going to sell them 8 weeks. It's going to cost.
Time value, you gotta.
Yeah, that's true, I forgot about the time.
Now, there are a couple of things to think about, though. You know, something some people do is they don't really even worry as much about the individual. Because they just, you know what, I'm worried about what the market might do, and they just constantly keep. And and out of money production. Okay? The idea being, I'm just worried the market's gonna go down, so I want to spend a little bit of money just to have some market protection. So you can think about it that way. If you truly start pushing the pencil and thinking about what, because if they're going now, you're talking, what, August?
August the earliest one,
Early, yeah,
December.
so you spend a lot of money, getting them that, getting there, but it's an option.
It's just like me. I guess I did something stupid, but at the time I felt good. But just in case the grain market had some catastrophic thing happen, go way up. A long time ago, I lost 2 cents,
Call.
calls, just in case. And I do have some on at all times.
So we won't talk about it for the program, but one of my favorite strategies actually is sell the forward or cash contract and then buy an open call. Because it gives you solid, it gives you immediate downside protection,
Yeah.
but at the same time still slow. So that's my favorite strategy.
Well, and that's what I was, last year when I was called you a time or two, that's what I was trying to
If
figure
you
out.
were, but you usually put some calls like this, so it's easy to speculate. If you had 3 things you could do, so number 1 is do nothing, number 2 is a straight hedge, sell more, and number 3 is buy a put option. What would be the best thing to do if you knew the market was going down? If you know it's going down,
Straight hedge.
absolutely, right?
Make more money.
If you know the market's going down, you lock in the price, right?
If you know anybody knows the market, you can call me and tell them.
And if you know it's going to go up, what's the best thing to do?
Nothing,
Nothing. Okay?
and then by put it goes.
And be honest, so I make this one, puts are never going to be the best thing to have done in hindsight, right? Because if the market goes up, you're gonna be out premium, right? If the market goes down, you've got premium plus whatever your difference is in your strike and the pool, okay? But they're also seldom going to be the worst thing to have done.
Right.
So they're typically a good middle of the road strategy. It gives you downside protection and still gives you some upside potential. That's my bias. Another way I like to kind of show people, and some people are more visual. I tend to be more visual.
Well, going back to
Sure, you're fine. Okay.
what Tim said about, time, typically how much time value should we actually be looking at? That's
Well,
what
I'd say grain and cattle are different, aren't they?
I'm talking about, okay.
Yeah, cattle.
And of course, with grains, I can use futures for grains. What, in 2018 now or something? Or more.
Wow.
So, the way that I kind of look at it is, you want to self-insure the risks that you're most concerned about. I'm just going to be honest with you. If I'm in your shoes, I'm probably not going to go ahead and price those 8 weeks now. And the reason being, you're a cow calf operator who also does some post-week stuff, okay? So I'm probably going to look at this, all right, I'm going to self-insure this cow calf phase. Because, give me these prices, and we'll do that. And when you get to that point, when you wean those calves, that's what I'm always, okay, now I'm a little bit worried about protecting this weaning value. Does that make sense? Doesn't mean I'm right. That's what I would do if I were in your shoes. A, it's going to cost you less, okay? And B, you've got a tangible opportunity cost here to kind of start from. There's nothing wrong with pressuring those cattle right now, other than what it's going to cost you to do it. I mean, you could spend $100 a head.
Someone knows.
Right. I don't think I can tell you.
I wasn't thinking that when I asked the question.
But this is fine, now, could you cash contract for August or December? Maybe. I mean, nothing wrong with that.
He did lower than me.
Just understand that, your neighbor may be better than you, the market goes up, and, it's just a risky trade. So I tend to think in kind of 3 to 6 months.
There you go.
Now, that's probably not best, but, the downside puts in these volatile markets is price. Very expensive. Real expensive. We kind of think about the overall market and what our net price would be. If I do nothing, so if I do absolutely nothing, The overall market's really good, I get a really good price. Overall market stinks, I get a bad price. There's your straight edge. Okay? Doesn't matter what the overall market does, I walked away with 148, right? And then here's what your put option looks like. I've got that price floor at 141, but if the overall market's really good, I can benefit. So what's the difference in the no protection and put option up here on the upper end? So if I'm on this side, the difference in no protection, which is the green line, and the orange line, the put option, what's the difference in those two?
The basis.
Good guess. This is all after basis. This is all after basis.
Oh.
Okay, so the 148 is my cash price.
The cost of food,
There you go. Which in our case was what?
$3.
So in a strong market, the only difference in the do nothing strategy and the option is the premium cost, right? Now on the left side, my straight hedge price was 148, my put option price was 141. What makes up that difference?
what they call it.
What is that? Where does that $7 difference come from? The first one's what?
Cost of food.
Exactly. So $3 of that, in our example, is the premium on the put. Where's the other $4 come from?
Don't say the basis again.
It's not basic.
Is it, $4?
But just not basic. So I sell the board. So I do the yellow trade. How far does the market fall before I make money on my short position?
Or about under 140.
Yeah. So if I sell the board first, if I do the straight hedge, I've got immediate downside protection, right? Immediate. Remember the strike price on our put? What was it?
56.
156. The board was at 160. So how much did I have to self-insure? Had to eat that first $4.
So it's a self-insured part.
So the difference in the straight hedge price and my put option floor is the difference in the current market and my strike. What I self-insure, what I kind of jokingly call our deductible, and in our case it was $4. Okay? And then I still got that $3. So if I'm running budgets, what am I going to do? I'm going to run a budget obviously at 148 sale price. Because that's what my expected profitability is if the market stays where it's at. And that tells me what I can lock in right now. And then I'm going to work with some different put option scenarios. And one of those is going to be I'm going to plug in 141. Because I want to know what my worst case scenario is. Okay? So if I'm looking to buy some calves in March and take them through the summer, maybe I think I can lock in 125 right now. Maybe by buying a put, I can guarantee myself at least $50 profit, and then I can hope for a home run. All right. Other questions? I'm in no hurry at all. I'll stick around as long as you want me to. Jeff, I know you had an appointment, so I was.
I just told you something about it.
Oh, okay. Well, I could talk another 20 minutes. So, anyway.
Well, I got a personal question that these guys, I don't mind these guys listening to. If I'm buying 6 weight bulls, processing them, getting them at a discount, and able to sell them on contract for delivery 100 days later,
So you keep them 100 days?
and try to get them close to 800 as I can, usually sign a 775 contract and then eat the slack, because I want as much weight as I can. Would I be better not, I guess, I don't know, what variables would be involved in a put versus a delivery contract?
Great question. So first of all, there's not as many opportunities like that you're describing. So the fact that you can do that, to me, is really, because that means you've got another potential strategy. Your cash contract you're talking about, understand, you've got solid downside protection.
Right.
You've really got probably the best of both worlds. It's the same thing as Jeff, it's the same thing as, Jeff or Josh or Don, Ford contracting grain for delivery over for a grain. It's the same exact thing.
Right.
You've got zero price risk, okay? What risk do you still have though?
Debt loss, but
Net loss, yeah. Rate of gain, you got production risk.
feed cost.
But I'm guessing you're more comfortable with those risks, are you not?
Yes.
You've managed those risks.
I can manage those.
So just understand, the only thing about that contract is you've got to deliver that many bulls or series whatever you do, at $7.75. So you don't have the price risk, you just got production risk. Part of the reason why I do so much on futures and options.
Well, and it's short term too.
Right, you can turn, yeah. Part of the reason why I do so much on futures and options for cattle folks, is especially when you get up in my area around Lexington, you've got almost zero forward contract options.
Oh, you just don't have that opportunity.
Hardly, it's very rare. We're very stockyard oriented, right?
Well, it's gone.
Well, there's plenty around. It is gone, though, you're right. You got plenty.
Bluegrass marked that. Oh, my, I'll show you some pictures.
Bluegrass Western, yeah. Saturday. Saturday.
Yeah,
Um,
gone.
something else you can think about, you don't have any upside in what you're doing.
Right.
You don't have any ability to benefit from market prices.
And
And that's okay.
so 2014, part of 2015, I left lots of money on the table, but I was okay with it.
And I would have been fine with it too. We were okay with leaving on the table 2014 as well. Because by the way, it saved our butts in one day. But, Jeff mentioned something, if you wanted to, you could grab an out of money call. You know what I'm trying to do, and give yourself some upside if you want. But it's going to cost you.
I'll just do it in case something goes black.
Yeah. Well, and I mean, if you think about the wackiness, what might cause wackiness might be a drought, right? And if it's a drought overall, you may have a drought too, that may help ensure your yield a little bit too indirectly. No, I like that. So if you're satisfied with having your downside covered and not having the upside, hey, no problem. I like that idea. Lots of folks would love to do what you're doing, they just can't where I'm at.
Well, when you can buy 6-weight bulls for $1.35 and sign a contract for $1.40 or $1.42 with basis, in only in 100 days, put 150 pounds on them, maybe even more. That's, you're gaining in price anyway. You just can't let him die.
You don't want to lose them, you don't want to gain one. Feed costs were in your favor now a little bit.
Yeah.
The other thing to make sure, Tim, is make sure whatever price slide you agree on versus the market, right? So, years ago, price slides were $4. Those are probably that wider now, I was going to guess. We're probably more than $8 slide now.
So how many people actually use futures and stuff on cattle and push?
Not very many.
The share of people is small, but the share of cattle that are covered is actually higher than you think, right? A lot of the small operators aren't going to use it, right? But a lot of the big stock operators background, even really large cow-calf folks, they're doing something to cover their risk. But there's a new product out there too that I know I've talked to you about it, is livestock risk protection insurance that's geared for smaller operators. And it's
You familiar with that? Might be something you want to learn about a little bit.
it's a good program.
It's just a tick more expensive than a put.
It varies.
I mean, are they still helping pay on the
They
premium?
are 13%. It's not subsidized to the extent of some of our insurance products.
You can insure for 90 or 90, even higher, I guess,
91.
percent of the,
Oh, yeah, you can go almost to 100 if you want to. But
And
it's,
but you could do it for 30 Ks versus having to have 60 for a semi.
you can buy them, however many acres you want to. What it really is kind of like a subsidized tuition.
There you go.
It's not as flexible as a foot. But if you're big enough, I still will put route. But if you're a small operator, you aren't big enough to use one.
You understand, it. There's a lot of guys that understand buying insurance, but they don't understand foot, which is the same thing. Okay. You been driving back and forth every day, or is this the first day you've been here?
I just drove down this morning. I got up about 5, looked at 6, nice here, about 9:30. If it had been any earlier, I probably would have came on out like before, but, you know, it's $100 expense, I get a room out or something, so if I can do it, I'd probably do it.
So you're driving back this afternoon?
Yeah, I'll do that. I'll pick the kids
You
up.
did that for 4 people.
Windshield time, but he's got it going on. He's also be on the cell phone. Kevin Ron called him twice before he gets to E-Team.
Kevin, I can do this.
I appreciate you doing this for us.
Thank you.
Yes, sir, I think 10 or 15 more of these, I'll have it.
That's good.
You know all this stuff?
Yeah, I'm working on it.
Iron, pretty tough.
Jeff and I went to Bowling Green last year and listened to top 30.
Top 30, I think I heard him
Mark
mention
Gold.
on Ag Day on the way down. I was to Ag Day sometimes when I'm driving.
Yeah.
I was on the radio.
Mark Gold is,
You good?
he's the dream guy. But, that can help. I like them because they just talk simple to a simpleton. And I just tell this guy, I said, look, I don't know nothing, I've got to do what you suggest, maybe. But I mean, and then the commission is just $35.
35
Per trade.
That's really good.
Yeah,
You're paying $1,000 up front, and then it's $39 a trade.
Okay, so stay like a membership fee almost $1,000.
well,
Well, essentially, what it
unless you lose it all in a call you shouldn't have bought, it's still in there. But when you get an email every day, which I enjoy that, it, you know,
The market.
and, I think to myself, how in the world can they afford to stay open at only $35, but then I had to realize,
thousands of clients.
well, them guys out west are buying, when I'm buying one contract, them other guys are calling in and saying, I need 15.
So most people around Lexington do growing machine commodities. And, of course, the commission, there's commission and trade fees and all this kind of stuff. The total ends up being about $85 or $90 per contract if you go through the growing machine. Now, one of my partners has like a trade account. We use about our trade, and I think it's like $7, something crazy like that. But we're not, we don't want to do it.
Where are you gonna put your next market now, since that golf ball started?
Good question. The closest market is actually Paris Stockyards, which is not owned by Bluegrass Stockyard Group. But Bluegrass Stockyard Group has one approximately 50, I'm guessing these are 50 miles south in Stanford, 30 miles east in Richmond, maybe 40 miles east in Mount Sterling, one northeast in Williamsburg, and then one to the west in Kansas. I mean, there's other options, but you know how it works. There's gonna be a little more transportation cost, right? Another 30 or 40 miles at, roughly $3 a mile.
Don't you guess that the city will end up, or the county will end up helping them rebuild outside of downtown?
So I went over there Monday, to do a little clip for Ag Day, actually, and ended up talking to a couple of different folks. And the girl with the Herald leader was just dying because they said about location. I don't know if y'all remember this or not, but several years ago, Bluegrass Sucker wanted to relocate.
Well, had the property bought, I think.
Had everything done. And we're basically cut off at the very last. So this is not something I'll say to.
No, but I mean, that was public, it's been 10 years ago, hasn't it?
I don't even remember. It.
10 or 11.
I didn't have as much gray hair. got shut down. The stockyard has never been there, it's really, it's right in town. I mean, in town branch, this creek they're trying to turn into this scenic creek, it's, I mean, literally right behind it. And getting tractors and trailers out of there is difficult. You know, we use goosenecks and we haul as a kid, and you'd be in line for a while. So I'm sure they'd like that location a little more accessible to the interstates. I just don't know how to check out. I mean, the thing about it now, they're gonna have to deal with it. They're gonna rebuild somewhere, what they'll do there. And I would think they'll probably try to get it somewhere else.
I'd say they'd stay in Vic, well, they might go to Scott County or Mercer County, I don't know.
Supposedly there's a holdup with Scott. One that I thought about was, and this is just me speculating, no one's told me this, but I thought maybe just to the west, like in Woodford County, there would be.
Yeah.
Somewhere in there.
But you know, the worst part about relocating anymore is the cleanup cost. I'm talking about EPA problems getting into the traffic.
Yeah, where all these older places have been grandfathered in.
That's a good point, and they may well find that that's
The
prohibited.
problem may be cheaper, they'll build right back where they're at.
Yeah, it's possible.
The city won't allow that, I bet you 10-1, they'll take care of whatever else it costs.
Yeah, I think.
They'll buy, they might buy.
Trooper.
But can you imagine what the cleanup cost would be for the stockyard?
I don't even think it is.
Well, I mean, I sat on the board at Kentucky until we sold it, I mean, it was farmer owned. And it was plain as day, if that stockyard ever sat empty or non-working for like 30 days, it was over, could never be opened up again as a stockyard.
Really?
And guys, you haven't lived, you mess with EPA water, which stormwater.
It did mess with them?
And yes,
Really?
well, I work with explosive district around all around the community. And we mix diesel fuel with ammonium on site, so that made some manufacturing. So we did that up to yeah, I'm food with additional water constantly, years.
Bunch of idiots work for them. They don't have any common sense.
We'll see if they sell them all.